First of all, welcome. Comfortable?
Thank you.
Ready?
Great to be here. Thank you for that kind introduction. And Charles, thank you for everything you do and all of your efforts on behalf of great corporate governance. I really appreciate it.
Well, y'all have had a huge role in it. What got y'all interested in the field to begin with? What part of in your career did you start thinking about building Trian? Where did it come from?
So in my previous life, I was an investment banker, as you pointed out, circa 1980s, 1990s. And I had two areas of expertise, so to speak. One was equity capital markets, and the other was financing private equity firms. And I think those two experiences gave me a perspective on what I felt was a need in the public equity market, which was helping management teams fix companies as public companies for the benefit of the public shareholders versus just selling to private equity. And I'll double click on that whole concept for a moment. I would submit to you that over the last 30 to 40 years, there's been a transfer of wealth from public share owners to private equity. And what really fascinated me was, why was private equity able to buy underperforming public companies, underperforming divisions of public companies, and turn those businesses around and make a fortune? What was it about the private equity context that allowed that company to perform so much better? Why was management able to pull levers that created all this value that, for some reason, public management teams and public boards just weren't able to do or weren't willing to do it? What was behind that? And I think if you do the math, you're talking about trillions of wealth, over decades transferred from public share owners to private equity. And that really got me fascinated, that concept. And you marry that with, I think from my equity capital markets experience, it was becoming clear to me that public share owners, as they got bigger, more institutional, more industry expertise, more sophisticated, they were starting to truly act like owners. And I think everyone in this room understands that, for most of the 20th century, the notion in the public equity markets was that if you didn't like what was happening at the company as a shareholder, your only option was to sell, right? Your option was to sell. And I started sensing that that mindset was changing, that the owners were starting to say, why do I have to sell? Why do I have to settle for that? I'm the owner of the company. Why can't I have more influence on making this company best in class? So there was a confluence of events for me that I felt there was a need and an opportunity. And my partners, it's important to understand, are turnaround operators. That's all they've done. They've had a storied career fixing companies going back to the 70s, Charles. And so for me, the opportunity was to institutionalize those turnaround skill sets. They had only done this on a smaller scale with their own capital, but to take in outside capital and do what they had done basically on a much broader scale and institutionalize that whole effort was the opportunity I saw.
When y'all decide to focus on a company, what attracts you to a company itself, whether or not to invest in it, and how to engage the company? What draws you to a particular company? Is it the board failure, company strategy?
Right. So
what do you look at?
So to frame that answer, we're looking to create a great risk reward for our investors, and we're looking to make our investors a very strong risk-adjusted return. And the way we're doing that is we're investing in fundamentally, I would describe the companies we invest in as fundamentally great companies, but where management has gone off track operationally, and where we think we understand what it takes to get the business back on track operationally. And I think if you distill down what we do for a living, as I mentioned, my partners' backgrounds, what we really do for a living as an organization is fix companies and turn businesses around. That's what we do. We're looking for companies that on the risk side of the equation have great brands, great market shares, great balance sheets, generate a lot of cash, have been around for a long time, will be around for a long time. But where on the reward side of the equation, earnings have not been optimized, where we think we understand, as I said, exactly what needs to happen operationally, and where we can go in and really help build the company, build the earnings, because at the end of the day, sooner or later, the company's going to trade as a function of earnings. And so our focus, I feel that our job is to work with management and the board to make sure our company is best in class operationally, best in class organic revenue growth, best in class margins, best in class return on invested capital, best in class corporate governance, and so forth.
Trian has been one of the funds that's been very successful in resolving their engagements with companies on getting appointments to corporate boards. Obviously, your board of BNY, New York, General Electric, Pentair, et cetera. You've gone on a lot of boards as well, not really a dissident director, as a differing opinion director. I like that. It's a little
highly
not
engaged,
as pejorative.
Sharon.
Highly engaged. It's less pejorative. I agree. What advice would you give to boards on how to deal with folks like you? I mean, what can be done to make management and boards much less apprehensive when you knock at the door and you say, "Hey, I'm on the board," more collaborative? How should they respond to you once you're there?
So first of all, what I would tell you, I go into boardrooms for a living. It's what I do. And we don't get results by raising our voice, by insulting people, by trying to embarrass people, by banging our fists on the table. We get results with the power of the argument. We get results by being very, very buttoned down with very strong analytics. That's number one. I will tell you that, and again, this is what I do for a living. In too many cases, and I'll say generally, and this is a generalization, but in too many cases, directors, even today, Charles, and there's been incredible progress, as you pointed out in your opening remarks, but even today, too many directors view the role as an honorarium versus a responsibility to us, the owners of the company. And unfortunately, too many times what you find in the boardroom are two types of individuals. One is a retired executive who is executing their retirement plan. And this is frankly, what you find. You find retired executives who don't want the stress and time commitment that goes with being a sitting CEO, but don't want to be on the golf course every day and want to keep a foot in the game. So they're going to sit on 3 or 4 boards and make $1 million plus a year. And if you think about that, there's not a lot of incentive to rock the boat. And there is a small search firm community, as you know, that is populating all of these boards, and there's no incentive to get a reputation with them as someone who is going to be disruptive. That's not a good dynamic.
Courteously so.
Yeah.
Disruptive.
Yeah.
Sorry.
But that's not a good dynamic. The other type of person you tend to find is someone who is a sitting executive who is looking to build gravitas, and that person also has no incentive to rock the boat, and oh, by the way, has no time, right? If you've got a sitting CEO, it's very hard for them to devote the time and energy to really add a lot of value. In most cases, again, I'm generalizing, and there are certainly exceptions. But that's the dynamic that we walk into. I guess my advice would be, obviously be good listeners, do everything you can to close the information gap that probably exists between management and the directors. You've written about that, and I think that's something we can spend more time on in this discussion, but hugely important. Spend time with share owners, research analysts, understand all the different perspectives on the company. Try to cut through the rhetoric to understand what reality is. And I'll tell you, my last point would be, don't over-index congeniality. And I'll tell you a story. I was, I won't mention the company, but I'd been on the board about a year. And at the end of the year, they tend to do a director survey. It's anonymous, where there's a bunch of questions about how do you think the board's working? What are your comments on how the board handles issues and so forth? And we were in executive session so it's really just the board, but the general counsel is going to take the board through the surveys and what was said in the comments. And the board used to be so congenial. Now it's not so congenial, and I don't like it. And boy, the dinners used to be so fun, and now we're just talking, and it used to be so congenial. And boy, I think congeniality is a really important, and this is not congenial, right? And obviously, it was an indictment of my my personal skills. But at the end of it, I said, I want to make a comment. I said, I don't want the boardroom to be a snake pit. That's not what I'm trying to accomplish. But while you were having congenial dinners and you were having wonderful retreats, we were the worst performing company in our sector. We had the worst total shareholder return. We had the worst organic revenue growth. We had the worst margins. Don't you want to win? I'm not looking to be disruptive. I'm not looking to make it uncomfortable. But I do want to facilitate a debate around the issues that we need to tackle as a board to be best in class. And I'll tell you what, I guarantee you, once we start winning, once we're best in class operationally, once we're best in class from a TSR perspective, once everyone is looking up to us as the leader, guess what? Those board dinners are going to be even more fun, right? Going to be even more fun, guarantee you. So let's start winning. That's what I want to do, okay? And I'm not trying to create an antagonistic atmosphere. What I am trying to do is have respectful confrontation so that we as a board can make this company best in class. That's what I want to do, okay? Ultimately, I was asked to be lead director of that company, okay? And so the congeniality thing.
It's actually kind of funny on that point. I mean, I've been a dissident too, and I think you have to introduce some professionalism, if you will, into the room. And if it's congenial, it's not. Congeniality is terrific if everything's going well. If it doesn't go so well, things should be a little less congenial to get people sort of thinking and stimulated. Because ultimately, if the directors are all shareholders, you're much more congenial if the stock has done well. Yeah. If it hasn't, and everyone else has, you hasn't. There's an Al Dunlap story, believe it or not, from the Voice from the Past, in his book Mean Business, where he talks about going to Scott Paper, and he walks in, and the first day he's CEO, they introduce him to this person. He said, "Who are you?" And she said, I'm the togetherness officer." He said, "What's a togetherness officer?" She said, "Well, I'm here to make sure all the senior management team gets along and it's congenial." He said, "How much we pay you for that?" She said, "About $200,000 a year." He said, "$200,000 to be congenial?" He said, "Yes." He said, "This company's doing terrible. Everyone ought to be killing each other." He said, by the end of the day, he said, we had one less congeniality officer. But it was, it wasn't a fun thing. It's fun when you do well. but you have to get to do well, and sometimes it's going to be not so fun. Look, you're seeing on the investor side a much greater focus on the shareholders, away from traditional, shareholder value to a broader stakeholder theory. You saw it in the BlackRock letter, you saw it in the Counselor's letter, where there's a greater emphasis on the part of investors on the, they call it ESG, on the ES, environmental and social issues, quote, doing good, as opposed to traditional shareholder value. Everyone's talking about it, the large funds are talking about it. Well, I'm sure we're going to hear about it on the panel.
Right.
How does this thing sort itself out? How do you link shareholder value to the ES? Because if ES takes over shareholder value, you're kind of back where you were 30 years ago with, basically managerial run companies.
I don't think they're mutually exclusive. My view is that if you show me a company that's best in class from an ESG perspective, I bet in most cases that company's best in class in a lot of different ways. Best in class, probably best in class operationally, best in class from a governance perspective. And it makes sense to me, Charles, because if you have a company that's being a positive force in their communities and in society, my guess is that company is going to attract the best talent, attract the best customers, attract the best vendors. I think there's probably a strong correlation. I can't quantify that for you, but my guess is there's a correlation. I feel it. I sense it. I think I think it's really good business. And, at Trian, we try to make our companies best in class from an ESG perspective. I'll give you an example. You mentioned I'm chairman of the compensation committee at Bank of New York Mellon, but it's actually the human resource and compensation committee at Bank of New York Mellon. And from that perch, I have a fair amount of institutional power with issues around, especially the S. And so, for instance, at Bank of New York Mellon, we're proud of the fact that today 46% of our U.S. workforce is women. A third of our U.S. workforce is diverse. We track that and monitor that and push those numbers very aggressively through the committee. We've had great scores with regard to climate change disclosure and protection, and so I think there's a strong correlation between your ESG efforts and sort of how you're going to perform in every aspect. That's my view.
Yeah, the two relate. I mean, again, you can't get to shareholder value unless you take care of the other stakes. Basically, the two are coexist.
I always say to my fellow board members, we need to be best in class at everything. Right? We need to be best in class at everything. It's not just revenue growth and margin. We need to be best in class from a governance perspective. We need to be best in class from a succession committee, and not just at the CEO level, but at every level. We need to be best in class from an ESG perspective. We need to be great at all these things, right? And we need to figure out how we're gonna do that and who's gonna be responsible for that.
Tough question for you. Ready? Got a lot of passive investors sitting out there, a lot of index funds.
I'm spring-loaded.
All right, ready. Here we go.
Dean Graham, I'm spring-loaded.
Right, there you go. What is the relationship, should be the relationship between the active investors, which y'all obviously are, because y'all sell and move out, and the passives, the long-term indexed? How should the two relate? And this came out in a proxy fight this past summer where there was a dispute, not a dispute, but a different viewpoint between the passives and the active investors. They both sort of went in slightly different directions. How should they relate?
I'm not sure I think there's so much of a difference when it comes to governance. We're all in the same boat as share owners. I mean, I spend a lot of time with Glenn and his colleagues, but we also spend time with the Capitals and the T. Rowe's and the Fidelities and the Franklins. And from my perspective, the other owners of the company are really part of their constituents of Trian, because we need their support to do what we do. And what I've watched as not just the big passive players, but also the big active players have invested more time, energy, and money into the resources to really have great points of view on all the issues around corporate governance that are coming up. And I think that's incredibly healthy. From my perspective, what we're trying to do is make sure they understand what we do and how we do it. And it's important for them, to believe that it's more than just words, that we're going to make this company better for the long term, right? We're not going to do something that's good for us in the next 18 months, but bad for the company over the next 18 years. We're going to actually go into the business, go on the board, and over the next 5 to 10 years, get the business humming and firing on all cylinders. And so, I think it's really a healthy dynamic where both passive and active are really galvanizing to have an influence on corporate events and corporate behavior. In a lot of cases, we're the tip of the spear as Trian.
Good analogy. There's been a big debate, a growing debate between long-term, short-term. There was a program here at the university that former Vice President Biden put on about the problem with short-termism versus long-termism. And an activist fund goes in, obviously, ultimately for a return, and it's usually shorter than the return of, quote, the long term, so they state. What are your thoughts on this whole debate between the two? Is there really such a thing as short-term investing, or is it everything long-term? And how do you separate the two out?
First of all, when you hear sort of the background to Trian, we started Trian and started putting in place the pieces for Trian before there was even the word activist. And we always thought of ourselves and think of ourselves today as a new asset class. We think of ourselves as liquid private equity or hybrid private equity. And that's how we've always thought about our business model. I will tell you this, and again, I do this for a living. I go into these boardrooms, and in most cases, it's the management team being short-term. And it's the management team trying to make quarterly numbers and getting the company into trouble. And I'll give you some examples around that. Sorry, I feel like I have my back to this side of the room.
I should.
So think about Wendy's. Dave Thomas died in 1997. Dave Thomas was a wonderful operator, founder of Wendy's. The business basically went into a downward spiral. We invested in our first investment 2005, by the way. For anyone who thinks we're not long-term, we're still the largest shareholder today. In 2005, the company was under a huge amount of pressure. And we felt the reason they were under pressure operationally was that they'd cut the quality of the food. Right? Trying to make quarterly numbers, they had continued to cut the quality of the food, and the consumer isn't stupid. Okay? Meanwhile, the competition was getting more and more intense. If you remember, back in 2006, we got them to separate Tim Hortons. I'll come back to that in a second. But we kind of muddled around. We had a couple people on the board, and what do? We set about fixing the business. And that started with the quality of the food. The fix on Wendy's started with changing the cut of beef, changing the condiments, changing the bun, changing the build of the sandwich. Then we went to work renovating the stores. The stores were, circa 1970s, and we started going about putting in place stores with flat screen TVs and Wi-Fi and fireplaces. And we started recruiting better capitalized franchisees who could actually invest in the stores, right? And build new stores and take advantage of white space. Now here's what happened on my end. 2009, stock goes nowhere. 2010, stock goes nowhere. I've got investors, and they're saying, what are you doing? So, well, we're changing the cut of the beef. We're putting in new condiments. We're putting in flat screen TVs, putting in fireplaces. We're going to get more drive-through traffic. We're really going to make this business better for the long term. And they're saying, but the stock hasn't moved. Okay, 2011, stock doesn't move. 2012, stock doesn't move. Okay. In effect, what we did was take the heat off of management. We went to all the shareholders and we basically said, we're going to pay a dividend and pay you to wait while we fix this business. But it's going to take us 5 years to fix it. Now, on my end, I had my investors on the other side that I also had to keep focused on the long term. And we would explain to them, we're doing all these things operationally. It hasn't shown up on the income statement. It's not like we sold the bakery, which we owned, and bought back shares. Okay, it's not like we sold the $1 billion worth of real estate and bought back shares. We didn't do any of that. We were fixing the business. But you can't fix businesses overnight. It's not flipping a switch and it's all fixed, right? It takes time. So we spent a lot of effort with our investors, some of whom are in the room, explaining that this would all work out. That's the Trian business model. As I said before, we are liquid private equity. We are really good, I believe, and time-tested and proven at fixing companies and working with management teams and boards to get the company fixed. But it doesn't happen overnight. It takes time. And I think it's important to be clear with all the other investors what the milestones are, how you're benchmarking performance, how long you think this is going to take. Be super transparent and communicative, right? And if you've got a smart plan and you're transparent and you're communicative, the other investors will galvanize behind you. And that's what happened in Wendy's. And our LPs galvanized behind us. And they appreciated what we were doing. And they ultimately saw the reward. And that's a good example. And I'll tell you, Heinz is another one where when we went into Heinz, earnings had gone down for almost a decade. And we had a fundamental conclusion why earnings at Heinz had gone down, which was in order to make earnings estimates in the early days of management's tenure, they had cut marketing expense to make the numbers. And when you cut marketing expense at a brand like Heinz, you can get away with it. You're not going to feel it at all for a year or two, maybe even 3. But sooner or later, it catches up with you, right? And all of a sudden, by the time we invested, deals and allowances, which is basically paying retailers for shelf space, had become 20% of gross sales, right? And marketing expense was 1.6% roughly. I think those numbers are directionally correct. So think about it, they'd gotten turned upside down, right? The best branded companies are paying a lot on marketing, right? Making sure that consumers want to go into a store and pay for their brand and pay a premium over private label. You can't do it without spending marketing, right? But instead, it was all going to the retailer. So what was our plan? We had a proxy fight over this. The Trian plan, 2006 with Heinz, was take the money away from the retailers and put it into marketing. It wasn't take the money away from retailers and buy back shares. It wasn't take the money back from retailers and pay a special dividend. It was take the money back from retailers in the form of deals and allowances and plow it into marketing and new packaging and new products that keep private label off balance. Now, why didn't management want to do that? When you take deals and allowances away from a retailer, when you go to Walmart and say, I'm taking away the deal and allowance, what happens? Volumes go down. They are going to make you pay if you go to them and take deals and allowances away. And management, who's already struggling to make their earnings, are now going to take away the deals and allowances and have volumes go down, which might last a year or more, right? That's why they weren't going to do it. In effect, what we did was give them cover to do that. And our point was, we'll come out so much stronger as a business when we come out the other end. And ultimately, Heinz had, I forget what it was, Brian, like 30 straight quarters of organic revenue growth, the best performing food company over the next 8 years. So you obviously hit a nerve with me on the short term. What
Wow.
we do for a living, you obviously.
I'm glad I did.
But that's, that's what we do, is stop the madness a lot of times on the short-term thinking. Stop the madness, okay? We need to build this business. I'll tell you, in the P&G proxy fight, at one point, Nelson was saying to management, I don't care about 2020. I care about 2030, okay? And how are we going to be successful by 2030? And I had, an experience with Bank of New York where at Bank of New York, we have a tax windfall as a result of tax reform. In January, when we announced our earnings report, Charlie Scharf, the new CEO, who I was head of the CEO succession committee and helped recruit Charlie. Charlie is fantastic CEO, comes from Visa and longtime JP Morgan executive. Charlie announced to the world, we're going to take the entire tax refund and we're going to put it into technology. And the stock went down 5%. And this was something that Charlie and I had discussed a lot. And I felt very strongly that we had to do this, right? Technology is the future of that company. It should be called the technology company of New York, right? And we're taking our entire tax windfall and plowing it into technology. Because things like blockchain, right, are going to transform the business, and we need to be best in class, okay? And the stock went down 5%. And Charlie called me and said, can you believe? And I said, Charlie, don't worry about it. We're doing the right thing. This is the right thing for the business. And I want to make one other comment on all this. I also think it's important for all the owners of the company to understand some of these other themes. One is we separate a lot of businesses. So we separated Tim Hortons from Wendy's. We separated Dr. Pepper Snapple from Cadbury. We separated Mondelez from Kraft. We're separating Pentair as we speak. DuPont obviously merged and is doing a three-way split. The separation is never about a static sum of the parts. I remember back in 2006 when this was happening with Tim Hortons and Wendy's, there was all this press and research about Trian's trying to get a 10% bump in the stock and then they're going to trade out. Okay, this is a long time ago. And what people didn't understand was that we were trying to create focus, right? In so many of these companies, you have different businesses under a corporate umbrella, and the complexity is overwhelming for the management team. And as a turnaround group, what we're trying to do is create focus. And just in order for you to understand how we think at Trian, and again, my partner's turnaround expertise goes back decades, and there's a philosophy that's been developed at Trian about how to be best in class. And it has to do with focus. It has to do with reducing complexity. It has to do with creating accountability, making sure there's someone in charge of the P&L, right? It has to do with making sure you're being really thoughtful about compensation and incentivizing people for the right behavior, right? So when we have we've had situations in companies where we've eliminated half the SKUs, half the SKUs. And think about that, half the SKUs, and every single SKU has its own raw materials, its own manufacturing process, takes up space in a warehouse, takes up space in an IT system, takes up space in the Salesforce's brain. And we've eliminated literally half the SKUs and lost less than 1% of sales, right? Complexity kills profit, right? You'll always see us go after complexity. You'll always see us try to create accountability. In the case of, in the case of a matrix organization, where we've had situations where you have people running huge businesses who don't have their own sales force, right? And you ask them why they're underperforming, and they say, well, I don't control sales. And then you ask sales, and they say, well, talk to manufacturing. And you talk to manufacturing, and they say, well, talk to distribution. And everyone's doing this, right? We need somebody accountable. So at Trian, we're going to go in there. We're going to unleash those forces of focus, reducing complexity, accountability, and we're going to get the business fixed.
Well, you're basically importing the accountability of private equity into public companies. And those who invest in a public company with you, or when you're there, get the benefits, if you will, of private equity discipline, which is actually why you want directors to own stock and to think of the company as their money as opposed to someone else's.
What's the difference in a private equity company? The owners of the board. That's the difference. The owners in a private equity company are the board. And they know the company as well as management, probably better. They've got a lot of skin in the game, and they're highly motivated, right? That's a private equity context. There's something about the ownership mentality in the boardroom that produces good results. And if you think about it, really what we do is bring an ownership mentality to the boardroom of big public companies. We'll never get it all the way to the private equity degree, but what we're doing is moving it up towards that end of the spectrum.
Which is really, if you think about it, that's what the whole director stock ownership movement was all about from way back. And big companies originally started as small companies owned by a few people. That's how they got to be big companies. And the larger you become more bureaucratic as opposed to entrepreneurial.
Yeah.
And the key is, how do you bring the two together?
Yeah.
And which is, you all have done a phenomenal job. Certainly Heinz was quite a great story. Yeah. Ultimately. Well, we're out of time, way out of time. You were good. I want to thank our Weinberg lecturer, distinguished speaker, and let's have a, wow.
Thank you.